Hello everyone, welcome to the 199th episode of me learning how to trade in Forex. We finished off the last two videos of the, trading, options trading strategy. So we went through short iron fly and short straddle strategy explained. So for short iron fly strategy explained, an iron fly is a short straddle with long options purchased out of the money to define the risk. Best case for an iron fly is for the stock price to land on the strike price at expiration. When selling an iron fly, the directional assumption is neutral. A short put spread is bullish and a short call spread is bearish, but since both is sold at the money at the same time, a neutral range of profitability is created. The spread is at the money rather than out of the money. Iron fly sellers benefit from an increase in premium and wider standard deviations when implied volatility is high. The higher the implied volatility, the more credit received. Keep risk in check by comparing the credit received to the width of the spread. Iron flies typically have a 1-to-1 risk to reward ratio. In a low implied volatility environment, the risk may exceed the potential reward. Our max profit for an iron fly is the credit received, and the max loss is width of the widest spread minus the credit received. Profit target, usually aim for 25% of the credit received. Upside break even is equal to the short call strike plus the total credit received, and our downside break even is a short call strike minus the total credit received. An iron fly is a neutral strategy because it combines a bullish short put spread and a bearish short call spread. Iron flies are profitable at expiration if the stock price is under short strike price exactly at expiration, and iron flies will realize a loss expiration if the stock price is beyond the break-even points of the in the money option. So then we went through the short straddle strategy. So a short straddle is a neutral premium selling strategy. A short straddle is selling an at the money put and call option on the same strike price. So this creates a range for the stock price to move through the credit received. Profit is made when the stock price lands between the break-even points and expiration. Short straddles can also be profitable prior to expiration through the passage of time or a decrease in implied volatility, which would reduce the value of the options. Best case scenario for short straddles is when the stock price stays on or close to the strike price and implied volatility decreases. Our upside break-even point is equal to strike price plus the total credit received, and downside break-even is the strike price minus the total credit received. Short straddles are directionally neutral trades, and when setting up a straddle, if the stock price is between two strikes, pick the strike which offers the most extrinsic value, as we're trying to minimize the directional exposure. So the more extrinsic value collected, the more space we have to be correct, and the less focus there is on direction. Straddle benefits from a high implied volatility environment. If implied volatility contracts without too much movement in the stock price, the straddle price could decrease, which could be bought back at a lower amount that it was sold for to get a profit. Our max profit will be the credit received again. However, this has a low probability of happening as for both options to expire worthless, the stock price has to be the exact same as the strike price at expiration, which doesn't happen too often. Our max loss is unlimited. Profit target, usually aim for the 25% again of credit received. And the straddle is a neutral strategy from the combination of a bullish short put and a bearish short call on the same strike price. The credit for a straddle is much bigger than the credit on a strangle for the underlying, and losses occur when the stock price breaches the break-even points of the in the money option. So that's the two videos we finished off, and now to finish everything off in the IG platform, I think we're doing the quiz now. So buying a call option gives you the right but not the obligation to buy a market at a set price before the start date, the right but not the obligation to sell the market at a set price before start date. Right, okay. So this is a I need to get it the right way around. Call option, so the call and the puts. I think call is the buy one. An option's intrinsic value is driven by factors affecting the probability that the option will expire in the money Difference between the strike price and the underlying share price. That. When would you employ bullish options trading strategy? If you think the underlying market price will increase. An option's extrinsic value accounts for the time remaining till expiration and the implied volatility of the asset, represents the real value of the option expiration date based on the underlying price relative to the strike price. Time remaining. A short straddle involves simultaneously buying a long call and long put of the same expiration and strike price. A simultaneous sell of a call and put, well, it's a short, so it's obviously going to be sell. The simultaneous sell of a call and put in the expectation that the underlying market will not move far from the strike. Yeah, so short, selling stuff. So buying a call option gives you the right but not the obligation to buy a market at a set price before a start date. Yeah, I just remember it by calling to buy stuff. So calling to buy stuff, and then for the sell stuff, you put it into the market for it to sell. So that's how I remembered it. Options intrinsic value is the difference between the strike price and the underlying share price. When do you employ bullish options trading strategy? If you think the underlying market price will increase. Okay, these are literally the same. Options extrinsic value accounts for the time remaining until expiration and implied volatility of the assets. Short straddle involves the simultaneous sale of a call and puts in the expectation that the underlying market will not move far from the strike. Right. Okay. And I think we are done here. So trading listed options, we just went through that. That's all done. Right, yep, that's all done, I guess. I like also, what's IG Academy? Right, so these are the went through the online course, live sessions, just live sessions. So these are the live sessions. Test, very nice. Okay, webinar library. Okay. Articles. So these are just information things. Okay, so still going to be useful, I think these are. What's a video hub? Right, okay. I think I'm going to wrap up on IG for the main online trading courses, because all these other ones seem to be like the sub, like not the official ones, I don't think. So for the official ones is done. Let me just write them. Oh my god, where's the top for this bit? It's so long, this is. Okay, so still a bit more stuff on IG to go through in the future date. Yeah, IG's done. Now we're back to these three tabs I have open. So first one, what causes inflation and price increase? I think this was when I was reading up about inflation in one of the last previous Forex lessons. and how it would affect currency prices and stuff like that. So I don't think this is that relevant right now. It is just good background information to know, but still useful nonetheless, so move it till the end. Next one, how to start forex trading beginner's guide. Okay, this is more useful. What's the next one? Day trading, the basics and how to get started. So this is part of a series, so I'm assuming this one is as well part of a series. So what series is Basic Forex Overview looks like. Basic Forex Overview. This is Day Trading Basics. Part of the series, Day Trading Introduction, Forex Trading Strategy and Education. Okay, so these are two completely different lessons. I think the main one to start on would be Guide to Forex. This is this one, I think. How to Start Forex Trading Beginner's Guide, because this looks to be Guide to Forex Trading Strategy and Education. What's this one? Trading Skills. Yeah, this is a bit more advanced, I think. So, how to start forex trading, a beginner's guide. So since this is the second article, let's go to the first one. Vestopedia. Is there anything here? Guide to forex trading. Trading. There's more here. Let's go trading. To trade stocks. What's it? Investing. Penny stock. How to trade forex. So are these the same thing? Forex, how trading foreign exchange market works. No, these are two different things. So is that like a official guide to forex trading? Oh my, there's a lot of stuff to go through. Trading. I think I was trying to open that window, wasn't it? Where is it? Guide to forex trading. Okay, so these are all the guide to forex tradings. Well, there's a load of articles here. This is a guide to forex trading as well. Strategy and education. View all guide to forex trading. Guide to forex trading. This is not to guide. This is not in guide to forex trading, is it? This is trading skills. So let's just close that one for now. Where is this one from? So terms, forex. How to trade forex. Part of the strategy. Okay, guide to forex trading. Forex trading guide. There you go. Explore guide to forex trading. Strategy and education. Advanced concepts. Let's go strategy and education. View all strategy and education. Advanced concepts. Okay, all. So strategy and education. Forex course for beginners. Right, okay, so it looks like this bit is the strategy and education. So I think how much information? I've got loads of information actually, but I know that some of them is kind of not relevant to what we're doing right now, which is Forex stuff, because the things we went through for the last few videos was actually about options, which isn't really what we're trying to do here. So I will need to filter out some information at the end to ensure that we're still like relevant to what we're trying to do. So let's pick some relevant lessons to do now then. So okay, so how to trade Forex. Where's this one from? Trading. This is just trading. More. Okay, I can't really find it, but yeah, let's just do this one quickly then, because it looks like it's only one page for some reason. So, how to trade Forex, Investopedia. And it's called How to Trade Forex. Date is the 17th 07 2024. Okay, very nice. So how to trade Forex. Learn what it takes to trade in the world's biggest, most liquid market. Updated 10th of April 2024. So still really relevant, recent. Okay, the foreign exchange market, also known as the foreign or FX or currency market, is the largest and most liquid market in the world. Represents the exchange of one nation's currency for another and is used for everything from travelers exchanging currencies to global financing. Forex represents the exchange of one currency to another. With over 7.5 trillion in currencies traded daily, the FX market impacts consumers in the global market, affecting the price of imported and exported goods. The FX market impacts consumers in a global market, affecting the price of imported and exported goods. To put this into perspective, the 5-day average daily trading volume for US stock and options traded daily is around 400 billion as of 2024. 400 billion US dollars as of 2024. While the foreign market is huge, 75% of FX trading is conducted in the 7 major currency pairs, all of which include the USD, with participants including governments, large international banks, regional banks, corporations and individuals. Foreign exchange trading continues 24 hours a day, with only the trading centers changing throughout the day. FX trading occurs 24 hours per day, with only the trading centers changing throughout the day. We'll look at how the Forex market works and what you need to know to trade in the financial world's biggest and busiest arena. So how to trade Forex. Trading foreign exchange market involves buying or selling one currency in exchange for another to another. The goal of trading is to profit from the changes in the exchange rates between the two currencies. So the goal of FX trading is to profit from the changes in the exchange rates between two currencies. To trade Forex, you will need to open a trading account with a broker that provides access to the FX market. After an opening account, you will need to deposit funds to use for trading. Once you have funds in your account, you can start trading by placing buy or sell orders for currency pairs. These orders can be placed through the broker's trading platform, which provides access to real-time pricing information and charts. To be successful in trading Forex, you will need to develop a trading strategy that takes into account factors such as market conditions, news events, and chart analysis. Yep, need to develop a trading strategy which covers market conditions, news events, and chart analysis. Trades are sized in lots, with the standard lot representing 100,000 of the base currency first of the pair. If you put a buy order in for USD CAD, for example, you're betting on the US dollar appreciating against the Canadian dollar, and this is considered a long position. If you put a sell order for USD CAD, you're betting on the Canadian dollar appreciating against the US dollar, and it is a short position. Trades are sized in lots. Standard lot equals 100,000 of the base currency. If you put a buy order for USD CAD, for example, you're betting the US dollar appreciating against the Canadian dollar. So if you put buy order in, you're hoping USD CAD is going to go up. So you're hoping it's going to take more CAD to buy 1 USD, therefore USD is strengthening against the CAD. So you're betting against US dollar appreciating against you're betting on the US dollar appreciating against the Canadian dollar. Yep. Long position, if you put a sell order for, you're betting the Canadian dollar appreciating against the USD. So put a short order in, you're selling the USD CAD pair, so you're hoping USD CAD is going to go down. So it's going to take less CAD to exchange for 1 USD, therefore CAD is strengthening against the USD, so betting on the US CAD appreciating against USD and is a short position. Yep. Foreign exchange traders typically utilize technical analysis for their trading, and many also use fundamental analysis to gauge the relative strengths of the global economies. It is also important to manage your risk by using stop-loss orders and proper position sizing. Use technical and fundamental analysis for trading. Manage your risk by using stop-loss orders and proper position sizing. Manage your risk by using stop-loss orders and proper position sizing. Before placing a trade, you want to know your entry level as well as your exit points for taking profits or minimizing losses. Trading Forex can be challenging, but with the right knowledge and discipline, it can be a rewarding and profitable experience. So steps required to trade Forex. Getting started trading Forex is relatively straightforward. While there are some differences in opening a traditional stock trading account versus a FX brokerage account, the overall steps are largely the same. Steps to trade Forex. Step 1, select a broker. The first step is to find out which brokers will offer you a foreign exchange trading account. If your existing broker supports FX trading and you have an approved margin agreement, you can skip ahead and begin trading. If not, you'll want to look at FX brokers, compare them in terms of platform capabilities, regulatory compliance, fees, margin rates, and customer support. Look at different Forex brokers and compare them in regards to platform platform capabilities, regulatory compliances, fees, margin rates, and customer support. Investopedia does a regular roundup of Forex-focused brokers to consider, and there are also large traditional brokers worth considering. Once you've identified a broker that fits your needs, opening a Forex trading account is a fast and easy process. Step 2. Open a Forex trading account. Step 2. Open a Forex trading account. To open accounts, you need to provide personal information including name, address, tax ID number, and some financial background information. You will also have to answer some questions about your finances and investment goals as part of Know Your Client compliance. Need to provide some personal information, including answer some questions about your finances and investment goals. When you open a FX trading account, it will include the execution of a margin agreement. Because currency trading includes leverage, it will include the execution of a margin agreement. An options agreement will be required to trade currency options, which can be accomplished through either over-the-counter options offered by some of the Forex brokers or exchange-traded options on currency futures. Okay, step 3, verify your identity. Step 3, verify your identity. Your broker will confirm your identity through your passport, license, or national ID. A copy of a utility bill or bank statement will also assist with verifying your address. The broker requests the financial and tax information to comply with US government laws and commodity futures trading commission rules. So this is the mainly US based, this guide seems like. Once your account and margin agreements have been approved, you need to fund the account to start trading. It should be noted, however, that some of the leading online Forex companies do not offer accounts to US customers. It should be noted, however, that some of the leading online Forex companies do not offer accounts to US customers. Why would they do that? Step 4. Fund your Forex account. So once your account has been approved, you need to fund it in order to begin trading. Some Forex platforms allow you to begin trading as little as $100, which at 2% margin or 50 to 1 leverage available for some markets, allows for a position of $5,000. Funding is typically accomplished by ACH bank transfer, wire transfer, debit card after verification, or check. So yep, step 5, research currencies and identify trading opportunities. Step 5, research currencies and trading and identify trading opportunities. Once the account is open and funded, Forex traders typically choose the currency pairs they want to trade. Then utilize technical analysis to determine their timing points and price levels for trade entry and exits. Like all markets, but especially leveraged markets like foreign exchange, trade size and trade management are very important to achieve the preservation of capital on losing trades and growth of capital on profitable ones. Choose a currency pair. Choose a currency pair to trade. And use, I'm going to write fundamental and technical analysis. I don't get why they missed out the fundamental bit. to determine their timing points and price levels for trade entry and exits. To determine trade parameters, I should call it that, trade parameters. Like all markets, but especially leveraged markets like FX, trade size and trade management are very important to achieve. So trade size and trade management is important to understand. Understand, is that the right word for it? Trade size and trade management is important to understand. It's important to learn about. Call it that. The overall financial condition of a country, including interest rates, plays into the value of a nation's currency, so there's a place for fundamental analysis in currency trading. News of fundamental data releases can also have a large impact on currency values. Beyond fundamental considerations, however, technical analysis is a critical part of a currency's trading because of the often fast-moving currency markets. Many traders focus exclusively on technical analysis to capitalize on the price action of the Forex market, using common technical indicators or technical techniques such as trend lines, channels, breakouts, patterns, and support and resistance levels to identify trading opportunities in the foreign exchange markets. The overall financial condition of a country affects the value of its currency. Step 6 then, size up your first Forex trade. Step 6, size up your first Forex trade. Before making their first FX trade, every trader needs to understand how much capital they have, as well as the specific leverage available to them for their chosen currency pair. Since leverage in Forex trading can be as high as 50 to 1, it is critical to understand how much capital you will have at risk on any trade. The 1% rule for how much capital to risk on an individual trade is a good rule of thumb for new Forex traders. This means you should only risk 1% of your total account value on a particular trade. Other traders may choose to use 2% or even 5% rule for the amount of capital they will allocate to any particular trade. Only risk 1% of your capital per trade, of your total capital per trade. The amount you're willing to risk, along with how far you're willing to let the market move against your position before taking a loss, sets the parameters of the trade. So basically your stop loss order. You should also set a take profit point if you tend to systemize your trading, but with the downside risk contained. You always have the option of letting winning positions run. Once the trade parameters have been determined, you're ready to enter the order through your broker's trading platform. Set stop loss levels and take profit level. You should also set a take profit point if you tend to systemize your trading, but with the downside risk contained. You can always have the option of letting winning trades run. Once the trade parameters have been determined, you're ready to enter the trade through your broker's trading platform. Step 7. Monitor and manage your position. Step 7. Monitor and manage your position. Once the position has been established, the trader should have a clear understanding of their position and, through their research prior to trading, have clear exit points for either taking profits or taking loss on their trades. Many traders will use a one cancels the other so that they will automatically take their profit or loss should either of these levels be reached, and cancel the remaining order. The traders should have a clear understanding of their position and, through their research prior to trading, so you should have your your stop loss and take profit orders. You should know where they are. You should know what they are before entering the trade, basically. Have clear exit points before entering the trade. Oh, I see, the one cancels the other one, so they'll set a take profit level and a stop loss level, and then if one of them is reached, so for example if the take profit level has been reached, then the stop loss order automatically cancels, and if the stop loss has been reached, then the take profit one automatically cancels. Right, okay. Could set a one cancels the other order, so that if a stop for stop loss and take profit levels. So to compare the best broker, Forex brokers, company IG, fees, spread costs, overnight financing costs, inactivity costs, account minimum $250, XTB, spread costs, commissions, overnight financing costs, inactivity fees, $0, plus 500. Spread costs, overnight financing costs, inactivity fees, currency conversion, guarantee stop order. Varies with instrument. Inactivity fees, so you're going to get charged if you're inactive. Okay. So what you need to open a Forex account, to open a Forex account for broker, simply need to provide your personal information and fund the account. Personal information, so account information, brokers often prompt you to create an e-account as the first step of onboarding. This generally involves providing email, creating a password and verifying the account. Personal information, you will need to provide your full name, date of birth and contact details including mailing address, email if not already provided and phone number. ID verification, you will need to provide a copy of the government issued ID such as driver's license or passport to verify your identity. Proof of address, you will need a bill or a bank statement that shows your name and address to confirm residency. Know your client information, you'll be asked about your occupation, income and investment information along with other questions to assess your financial situation, trading experience and risk tolerance. Financial information, your bank account details may be requested for setting up funding via bank transfers. Personal information needed to open a trading account. So account information, personal information, ID verification, proof of address, know your client information, and financial information. Cool. So minimum deposits for a Forex trading account can be quite low and may not even apply at all. Due to the role of leverage in trading, in Forex trading however, it is a good idea to have enough risk capital in an account to actually engage in a meaningful trading. Even if you can open an account with a $0 minimum, trading with a small account balance is difficult and can severely limit the range of price action you can handle on any one position. Although there is no hard and fast rule, a balance of 2,500 in risk capital is a good starting point for developing your FX trading skills. Small account balance can severely limit the range of price action you can handle on any one position. A small account balance can severely limit the range of price action you can handle on any one position. So ensure you have a decent starting amount. Cool! I'm going to leave this episode here then. So in the next video, gonna carry on back on track on the Forex stuff with understanding the basics. Peace.